This is Nightly Business Report with Tyler Matheson and Susie Garrett.
Early fireworks. The Dow pushes towards 17,000 on the first day of the trading of the second half. With that milestone within reach, what will the rest of the year bring?
Defying predictions. People flocked to auto showrooms, it turns out, and drove off with more vehicles than expected last month, despite the rash of recalls.
And behind closed doors, a look inside the room where Google is quietly trying to take on Twitter. We have all that and more tonight on Nightly Business Report for this Tuesday, July 1st. Good evening, everyone. I'm Susie Garrett.
And I'm Bill Griffith in for Tyler Matheson again this evening. Wall Street kicked off the third quarter with a bang today, a record-breaking session that saw the Dow come within a couple of points of 17,000. The blue chip average, the S&P, and the Dow transports all closed at historic highs on the heels of strong manufacturing activity data that we saw both in the U.S. and in China. The rally was led by gains in healthcare, technology, and consumer discretionary stocks, which had lagged recently. Here's how the major averages ended this day, with the Dow up 129 points, making its biggest one-day point gain since May the 21st, and it came within 2 points of the 17,000 mark around midday before giving up some of those early gains. The Nasdaq was the strongest of the major averages, up 50 points, reaching a fresh 14-year high, and the S&P was up 13, notching its 23rd record close of the year. So with the Dow at 17,000 now in the crosshairs and the markets at new highs at the midpoint of this year, a lot of traders are now thinking about rejiggering their portfolios, looking to maximize profits ahead of the second half of the year. Dominic Chu has more.
Many traders are taking advantage of this halftime to make adjustments to their portfolios. Certain parts of the stock market have fueled the rise, especially in the second half of each year. Since 2009, the best performing second half sector each year has been consumer discretionary. It's been up an average of over 16% during the last 6 months of each year. Part of the reason might be the increased spotlight these stocks get because of the holiday shopping season. It's noteworthy that consumer discretionary stocks are among the biggest laggards in the S&P 500 so far this year. As for the worst performing sector in the second half of the year, over the last 5 years, it's been utilities, up only an average of 5%. Ironically, utility stocks are the best performers in the S&P 500 so far this year. But knowing the past doesn't always help predict the future. Some experts are looking for profits elsewhere in the market.
The energy sector is the sector that I think investors should focus on. First half of the year, it clearly had very low expectations, but in the reality of pure performance, the energy sector in the first half of the year is one of the best performing sectors.
And it's not always about what you're buying, but also what to avoid.
We believe a lot of the sectors that have been pushed higher in the first half of the year by lower interest rates will see subpar returns during the second half of the year. REITs and utilities have done very well, and therefore we would continue to look to underweight those asset classes.
After a big run for stocks last year, many traders were looking for fewer gains this time around. But with stocks making fresh record highs and the S&P 500 already up 7% so far this year, reassessing your second half playbook might be the prudent course of action. For Nightly Business Report, I'm Dominic Chu.
Joining us now to talk more about this big trading day and your investment strategy, Patricia Edwards, Managing Director of Investment at U.S. Bank Wealth Management. So, Patty, what a day. I mean, a lot of people tuning in tonight are probably wondering what happened all of a sudden. The stock market has been going up slowly all year long, and then this big rally, talk of 17,000. I mean, what would you say? What happened? What changed?
Well, there's a couple of things. Fireworks are always nice this week. We like that. But beyond that, it's the beginning of a fresh quarter. So you have a couple of things going on. You've got retirement plans that are making their contributions either for the month or for the quarter. That starts to push things higher. We have economic data that's coming in that is just a little bit better each time. It's not anything earth-shattering, but it's continuing to build that confidence. And then on top of that, what you saw in the rallies, you saw things rally that we have not seen rally over the past quarter. Right. So small caps, things like that. And so you've seen, I think, a lot of the mutual funds that they've got a report as of June 30th, what they're holding. Now they can rejigger their portfolio for performance and pick up some of the stuff that's lagged.
Yes, that was interesting, Patty. I mean, the defensive stocks, for the most part, led the way the second quarter. Those, I don't want to say safe haven plays, but they're cautious plays that pay dividends that people run to when they're not sure growth is going to be all that strong. That wasn't the case today. A lot of those laggards were leaders today. Do you think that's going to be the theme for this quarter?
Well, the theme for this quarter is really going to be completely data dependent, we think. What we're watching on is the earnings. If the earnings are there, then I think you're going to start to see a little bit more growth. You're going to start to see some purchasing, not only in the energy sector, which we like, but also things like manufacturing, because energy costs should be coming down rather than going up with all of the natural gas that we've got coming into the pools here. So there's a lot of things that could start to go well that will actually drive the entire economy rather than just the stock market.
Mm-hmm. Patty, are you concerned that we haven't had a serious correction in a long, long time? I mean, a lot of market strategists say it's healthy to have a correction, and we haven't had one. Should we be concerned about that?
You know, it is healthy to have a market correction. On the other hand, it's also healthy to look at where you're trading versus earnings and what kind of performance you've had. So I have a lot of clients who will talk to us and say, geez, you know, we're up 180% or so off of the bottom in 2009. You know, shouldn't we be selling our equities? We look at it, and if you graph the equities versus the earnings that those companies have had, we're just barely slightly overvalued. We're a little bit more cautious because we are slightly overvalued, but we're by no means in record territory. And on top of that, you've got companies that have a boatload of cash on their balance sheets. We're back at levels that we haven't seen since the 1960s. And we're going to start to see more dividends paid. We're going to start to see more stock buybacks. And we're going to continue to see mergers and acquisition.
We're taking note of the Dow at 17,000. Certainly it's a benchmark that we need to keep an eye on. But, you know, technology stocks, the NASDAQ has had an even better run lately. It was up 6% in the second quarter, where the Dow was up only 2%. Today, it was up 50 points, 1.25%, where the Dow was up less than 1%. Do you like technology here?
We do like technology, and part of the reason for that is that these companies in the S&P and throughout the market actually are going to have to continue to grow their earnings. And part of the way you grow your earnings is you spend on technology, you get greater productivity out of the people that you've got there, and then you start to add headcount. And we think that's actually been going on for a while, but there's more to come.
I'd like to get your thoughts on what individual investors should do. As you know, a lot of them have been sitting this out. They're sitting on a lot of cash. You know, is it too late to get in at this point? Is it ever too late?
Well, frankly, I think for a well asset allocated portfolio, it's never too late. That being said, I think you need to take into consideration a few things. First of all, in terms of world equity, the U.S. is only 48% of world equity. That means that 52% of the equities, stocks that trade in this world aren't here. So if you don't have exposure to international, both developed international markets as well as emerging markets, you might want to start to look at that. If you're going to be trading in the U.S., you might want to start looking more toward the small caps and the mid-cap stocks, because if there is going to be M&A, those are going to be the folks that are going to be taken out. Joining
the conversation right now is Jonathan Golub. He's Chief U.S. Market Strategist at RBC Capital Markets. Thanks for joining us here, Jonathan. Do you see this continuing? Is this kind of trading that we saw today, this rally, could this be set the tone for the third quarter, or do you see us going into the summer doldrums, as sometimes happens?
Well, you know, a day where the market's up between 0.5% and 1%, you want to be careful to not project that that's what we're going to see. But I think that we're going to see a continued very strong run in the markets, very similar to what we've had in the last several months. And the key is a lot of this is driven by better economic news and corporate profits.
And what about what Patty was talking about, IPOs and M&A? Do you see that theme continuing? And we've got this big IPO everybody's talking about, Alibaba. Is that going to feed the momentum?
No, I mean, at the end of the day, IPOs are not going to be the thing that drives the market. And some of the M&A that you've seen is actually not driven by, corporate excitement about the economy as much as them moving some of their businesses offshore and doing things to enhance their earnings by cutting some of these tax burdens. But the reality is that we have an economy which is on solid footing. It's getting better, and that really is the fuel for the market.
All right, terrific. Jonathan, thank you so much. Jonathan Golub from RBC Capital Markets and Patricia Edwards with U.S. Bank Wealth Management. Thanks to both of you.
Well, there was another sign of strengthening U.S. economy when auto sales for June were released today. They defied predictions of a slowdown in big-ticket consumer spending and instead saw sales accelerate to an annualized pace of nearly 17 million units sold. Ford sales, though, did fall last month. That sent that stock a bit lower today. But otherwise, shares of other automakers saw modest gains on Wall Street. Phil LeBeau has more on June's surprisingly strong auto sales and which automakers stood out.
A surprising day for automakers as they reported June sales that were better than expected. You can credit that to a relatively healthy economy and continued pent-up demand for new vehicles. Take a look at the big three. Of these numbers, the one that stands out here, General Motors. Sales increased 1% last month. Many were expecting sales to drop 8.5%. Chrysler, another strong month. This brand has been on a roll. Jeep in particular is red hot, up 28% last month. As for General Motors, we mentioned how sales were actually up last month. That's despite the fact that the automaker is recalling 28.96 million vehicles worldwide, and almost 12 million recalls were announced last month in the U.S. Still, June sales up 1%. That's the reason why a number of the auto stocks all got a bit of a bounce today, as many people are looking at the industry and saying, if June sales pace is on par with a strong May, what can we expect for the rest of this year? We'll have to wait and see. That's the story regarding June auto sales. Phil LeBeau, Nightly Business Report, Baltimore.
Well, General Motors isn't the only automaker plagued by defective ignition switches. Chrysler said today that it's expanding its own ignition switch recall. It's calling back another 700,000 vehicles that have ignition switches that can be shut off. This includes older models of previously recalled Dodge Caravan and Chrysler Town & Country minivans, as well as the Dodge Journey crossover vehicles from the years 2008 and 2009.
Well, talks are still ongoing, continuing past various deadlines as negotiators look to seal the deal finally on a new contract at those 29 ports along the West Coast. A new 6-year deal would cover 20,000 dock workers from California to Washington State, including the major ports of Los Angeles, Long Beach, and Seattle-Tacoma.
Well, the threat of West Coast ports shutting down isn't the nation's only transportation crisis. The White House is warning that gridlock in Congress will lead to gridlock on the nation's roadways if lawmakers can't agree on how much to pay for much-needed federal highway and transit repair programs. And President Obama warned that unless money is found, hundreds of thousands of jobs could be lost.
If this Congress does not act by the end of the summer, the Highway Trust Fund will run out. Won't be any money there. All told, nearly 700,000 jobs could be at risk next year. That would be like Congress threatening to lay off the entire population of Denver or Seattle or Boston.
U.S. Transportation Secretary Anthony Fox said states will begin feeling the pain of cutbacks in highway programs as early as the first week in August. And still ahead, Google's latest experiment and how it's trying to take on Twitter with the World Cup and a war room. We'll explain. Southwest Airlines is cleared for international takeoff, and that's where we begin tonight's market focus. The carrier is launching flights to destinations outside the U.S. for the first time ever. New destinations will include Jamaica, the Bahamas, and Aruba, but Southwest will expand its service to other locations over the next few months. The airline is taking over routes flown by AirTran Airways, which it bought in 2011 and plans to eliminate by the end of the year. The stock rose more than 3% to $27.73. T-Mobile has been accused by federal regulators for adding bogus charges on customers' accounts without their consent. The Federal Trade Commission says the wireless carrier tacked fees onto customer bills totaling hundreds of millions of dollars, labeling them as third-party charges. T-Mobile CEO says the complaint is unfounded. Shares fell a fraction to $33.41. Shares of Regeneron popped on news that the French drug maker Sanofi will increase its stake in the company to 22.5%. The move is part of an agreement between the two companies allowing Sanofi to buy up to 30%. Regeneron rose more than 7% to $303 and change, making it the best performing stock in the S&P 500 index today. And the second best performer in the S&P, Netflix. Its shares were higher on an analyst upgrade. Goldman Sachs rates the stock a buy, that's up from neutral. The firm cited the video streaming company's international expansion and the opportunity to increase profit margins as its customer base grows larger. The stock jumped more than 7% to $473.10.
Hormel Foods is buying Cytosport. They are the maker of muscle milk for nearly $500 million. That move is an effort for the Spam maker to expand outside of its meat products and diversify its offerings into protein drinks. Shares of Hormel fell a fraction to $49.19 today. Aerospace and defense products maker Lockheed Martin is freezing its current pension plan and instead is transitioning its employees to a defined contribution plan. That new plan will go into effect in 2016 to help the company manage the long-term cost of its retirement programs. Shares of Lockheed Martin down a fraction today, just above $160 per share. And Twitter has a new chief financial officer. The social media company has tapped Anthony Noto, a former Goldman Sachs executive who was instrumental in helping Goldman win the lead underwriter role on Twitter's IPO last fall. Shares were up more than 2.5% on Twitter to close at $42 and a nickel.
Google did some shopping today, buying Songza. It's a streaming music service with 5.5 million users. All 40 of Songza's employees will be joining the search giant, but no word on the price tag.
World Cup play continued today with the U.S. taking on Belgium, but there's another big rivalry taking place between Google and Twitter over which company can provide users and advertisers with the best real-time trending. Well, the information during World Cup matches and other major events has been a big sticking point for these two companies, and Josh Lipton has more.
USA! USA! Soccer fans gathered today in bars, homes, and offices to cheer on their teams during the World Cup.
There's an article in BuzzFeed, there's been an article on SI's blog.
In a loft in San Francisco, a group of Google employees were also watching the game, only they were watching for work.
The U.S. cannot stop talking about Teddy Roosevelt.
Welcome to Google's World Cup War Room. Fans all over the world use Google to search for information during the World Cup. So far, Google says there have been 1.5 billion searches.
And in 2010, the World Cup had more interest than the Olympics, the Tour de France, and the Super Bowl combined. So I think we shattered that even more this year with 1.5 billion searches so far. Other big sporting events generally are in the hundreds of millions.
A group of Googlers meet in this office every day during the World Cup to mine those searches for information. Data analysts first identify the most popular topics in these Google searches. Designers then create infographics, which are posted on Google's website, as well as shared on social media and with broadcasters such as ESPN.
Google is part of this conversation around the World Cup, not just for the first time, but really in a new way.
For example, as Colombia made it into the quarterfinals, James Rodriguez became the most searched for player on the planet. So the Google team produced this infographic to showcase that trend. Financial analysts who cover Google say that the search giant is taking on Twitter with this project. Twitter breaks down millions of tweets for trends and information that can be useful for advertisers. Google is trying to show advertisers that it can be every bit as capable as Twitter when providing real-time analytics of events. Google has engaged in these kinds of projects in the past for events such as the Super Bowl or the Oscars, but the company says that it has never conducted one on this global scale. And at the end of the day, it's all about generating more advertising dollars for Google. Neil Doshi of CRT Capital says Google is trying to prove there are vast amounts of data that are not fully being utilized. If Google can start to present interesting ways of packaging this data, that could be very compelling to advertisers. Now we'll wait and see whether advertisers are impressed by these real-time snapshots of what fans are thinking as players take the field to battle for that World Cup trophy. Josh Lipton, Nightly Business Report, San Francisco.
Well, coming up, it's General Motors versus Toyota, two of the world's most recognizable brands competing in countries across the globe. And tonight, the two go head-to-head in NBR's Ultimate Stock Cup. The World Cup, as you may know, is now in the knockout round with teams hoping to reach the tournament's quarterfinals. And in the latest round of NBR's own Ultimate Stock Cup, we pit the world's two largest automakers head-to-head to see who comes out on top in the global marketplace. It's the U.S.'s General Motors and Japan's Toyota. General Motors, GM, the world leader in auto sales every year from 1931 to 2007. Founded in 1908, GM is headquartered in Detroit. 2013 revenue, more than $155 billion. And the list of past and present GM brands is a who's who of American automobile history. Icons like Buick, Oldsmobile, Cadillac, Pontiac, GMC, and Chevrolet. And it almost came to an end with a bankruptcy filing in 2009. But GM was bailed out by the federal government. And last year it sold more than 9.7 million automobiles, trailing only Toyota, which sold more than 9.9 million. But GM outsells Toyota in both China and the United States, the two largest markets. Japan's biggest company by market cap, it was founded in 1937, and it's headquartered in Japan's Toyota City. 2013 revenues were more than $222 billion. GM may outsell Toyota here in the U.S., but the Toyota flagship Camry sedan has been the best-selling passenger car here in the States for 15 of the past 16 years. Also notable, the Toyota Prius became the world's first mass-produced hybrid in 1997. Its other brands include Scion and Lexus.
Well, let's turn now to Ephraim Levy to weigh in on this rivalry. He favors Toyota and joins us now. He's with S&P Capital IQ. Why Toyota over GM? What are the strengths?
Well, we don't differentiate between two companies that we have a strong buy on, which is the case for General Motors and Toyota. But if you take the market close relative to our target prices, the edge is Toyota, which has 30% potential upside over the next 12 months versus 28% upside for General Motors, so that's pretty close. Both of these companies are benefiting from rising global demand. It's a favorable industry trend. You have a lot of emerging markets. People are buying cars for the first time. And back home in America, you have a rising market with a strong economy. You have a lot of new features, technology, and the average age of a vehicle is over 11 years old. So you have people coming in to the dealerships to buy cars, and that helps both of these companies.
No question, Ephraim, the GM recalls have been a disaster for that company from a public relations standpoint. Do you think it dents their sales? Does it tarnish their brand? What do you think about that, especially when you're comparing it to Toyota here?
Sure. It's something you don't want to have. It's something that weighs on the brand image to a certain extent, but we don't think that it will make a major difference in terms of the company's sales, which is something we've seen in the past 2 months for May and June, where their sales were actually pretty good for a company that has a lot of recalls. And the reason we think this is because it's that recalls are part of doing business in the automobile industry. You're going to always have recalls. Some will be smaller, some will be larger. You want to keep out the headlines. And if you have a situation where people are dying from it, like the ignition recall, that's going to hurt mostly the people who've been involved with accidents and know the people. But overall, they have a broad enough brand that they can be disciplined and people will stick with them and expect them to do better.
You know, Ephraim, you say that the auto industry always has recalls, but in this case of Toyota and General Motors, they both have had or are going through very high-profile credibility issues with their recalls. When you look at it from a crisis management point of view and how these two companies have handled it, in the case of Toyota, it's in the past, and GM is currently, who's been doing a better job?
I'd say that the edge for this goes towards General Motors. In part, they learned a little bit from Toyota's experience. Toyota had a problem that they were not acknowledging once the news was out, and they did a bad job with their public relations. GM, obviously, this is old news that should have been disclosed a long time ago, but once it was out, they went to the forefront. They had the advantage at General Motors of a new CEO who was not involved, and she's showing that this is a new GM, not the old GM. This is not going to be stood for in the future.
Very quickly, alternative fuel sources. Do you give Toyota points because of the Prius, the hybrid that has reached mass appeal at this point, or what do you think about the comparison there?
Absolutely. Toyota has a clear advantage. The Prius and the Prius family is the #1 selling a hybrid vehicle. If you're buying one, you're most likely going to buy a hybrid. Obviously, there's other, a Prius. Obviously, there's other choices out there, but they're #1 in the mindset of the customer.
All right, Ephraim, thank you so much for joining us. Ephraim Levy with S&P Capital IQ. And so you just heard what our guest thinks, and now we want to hear from you. Which stock do you prefer, General Motors or Toyota? Go vote on our website, nbr.com.
And now the results from last week's Global Rivals Challenge, where we asked you to choose between General Electric and Siemens of Germany. You picked GE. It was a clear victory, by the way, with 64% of you voting for the U.S.-based conglomerate.
I think so far there have been mostly votes for the U.S. companies. Do you think there's a bias?
I wonder why that would be. Good job.
That's Nightly Business Report for tonight. I'm Susie Garib. Thanks so much for watching.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.
I'm Susie Garib with a Nightly Business Report news brief. Some early fireworks on Wall Street today. Investors kicked off July with a record-breaking session that saw the Dow, the S&P, and the Dow Transports all closing at historic highs, thanks to strong manufacturing activity both in the U.S. and China. The Dow shot up 129 points, but fell 2 points short of the 17,000 mark in intraday day trading before giving up some of those early gains. The Nasdaq rose 50, reaching a fresh 14-year high, and the S&P was up 13 points, notching its 23rd record close of the year. And U.S. auto sales were revved up in June, approaching 17 million units sold this year. Chrysler rose 9%, and despite millions of recalls, even General Motors posted a 1% gain. But at Ford, sales fell 6%. Be sure to tune into Nightly Business Report right here on your public television station.